We're asking about the UK's new Prime Minister trying to channel the boldness of Margaret Thatcher. Markets have been spooked by Liz Truss's tax cuts for the rich. Let's get the latest in this saga with our business editor, Kate Moody. With this Wednesday, the Bank of England forced to intervene.
Yeah, unprecedented emergency action from the central bank. That's because this week we've seen the British pound plunge to record lows against the dollar. Bond yields have spiked to their highest level in nearly 2 decades, while the government doubles down on that pledge to cut taxes and tackle inflation. Now, on Wednesday, the Bank of England made an emergency intervention in the markets, saying it would start buying £5 billion worth of long-term government bonds for an initial period of 13 days, around £65 billion total. That's around 72 billion euros. Now, a yield is basically the interest that investors earn when they buy a government bond or a stake in government debt. Bonds are issued for different amounts of time and with different interest rates. Longer-term investments usually have higher yields or rates of return because they're seen as riskier. Now, we can take a look at how the yield on a 10-year bond has evolved over the past decade in the UK, today soaring to its highest level since 2007, and that's because investors are really less confident in the economy's future. The action by the central bank trying to calm those concerns. A statement from the Bank of England saying, were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability. The purpose of these purchases will be to restore orderly market conditions. It went on to say it would continue for as long as is needed. Analysts say the Bank of England was forced into action.
It does smack of a bit of panic and frustration that the government isn't doing more to retreat away from these promises of mass tax cuts. The Bank of England has intervened again because it's clearly worried about the rapid shooting up of that interest rate payable on government bonds, which is used to set a whole raft of financial instruments. Not least, it really does govern what rates banks and building societies lend to homeowners.
Well, the latest round of market panic was sparked in part by an unusually direct statement from the International Monetary Fund criticizing the plan to slash taxes. The IMF said, given elevated inflation pressures in many countries, including the UK, we do not recommend large and untargeted fiscal packages. It is important that fiscal policy does not work at cross purposes to monetary policy. The IMF is suggesting there that the central bank's efforts to keep inflation in check by raising interest rates will clash with the government's plans, which require more borrowing. Let's check in on the day's trading action now. The pound holding steady at about $1.07. It had dropped earlier in the session, still not sinking, though, back to that record 104 that we saw briefly on Monday. A weaker pound tends to boost stocks of the export-focused companies that are on the FTSE 100, and so we did see that market climbing about a third of a percentage point. The major other European indices in Paris and Frankfurt each closing slightly higher there. Wall Street's also trending higher. The Dow Jones up about 400 points, 1.3% this hour. Shares of Apple are bucking that positive trend. They're down 3%, following a Bloomberg report that the tech giant is backing off plans to increase production of a new iPhone because of weak demand. The EU's latest round of sanctions against Russia are likely to further tighten the strain on the economy. The European Bank for Reconstruction and Development forecasts that GDP will contract around 5% in Russia this year. I've been speaking to the bank's chief economist, Beata Javorcik.
So we are projecting a 5% decline in Russian GDP this year. This may seem optimistic. Nevertheless, we already see sanctions having a bite on Russian economy. Imports are down, and manufacturing sector, particularly industries that rely on intermediate inputs that come from abroad, have registered much worsened performance. So far, Russia has been doing better than expected, thanks to huge revenues from exports of oil and gas. But the longer the sanctions continue, the greater the bite they will have, and they will slow down productivity growth and economic growth in the years to come.
That's all the business news for now, Francois.
All right, many thanks. Kate Moody will be back with more business news. Let's